Here's the thing you need to keep in mind. It's not just Bitcoin. All major cryptocurrencies are witnessing a volatile stage in the market right now. It's nothing new. Bitcoin's price has been dropping since late November and early December in 2021. Currently, the market value of BTC is stuck below $50,000, and investors are getting anxious as to when the crypto will break the barriers and cross the mark. The price of BTC shot up shortly after the Biden administration initiated the executive order that encouraged crypto adoption in the country. According to the order, the Biden administration is currently examining the opportunities created by the rise of digital assets. This report was welcomed with open arms by those investors who believe that Bitcoin will eventually rise in the future, but the order also triggered some traders to sell their Bitcoin holdings. Bitcoin's initial dive in price from more than $65,000 to below $40,000 is somewhat equal to the cryptocurrency losing nearly half its value. The crypto jumped back above $45,000 around March and continued to move forwards around $47,000. This upward trend in prices persisted throughout the week, indicating an increase of more than 15% within the span of a week. In this video, we will take a look at what made BTC prices go down and whether there's going to be another bear market trend for Bitcoin. Stay tuned. The state of Bitcoin has been quite volatile, the crypto losing more than 40% in the last 4 to 5 months. It is quite clear that Bitcoin is rising, but it is also falling. As crypto that drove the entire growth of the crypto market is going down, investors are left shocked. However, some crypto experts believe that Bitcoin will unbelievably reach $200,000 by the end of this year. But why is Bitcoin losing value? Let's take a look. Why did Bitcoin go down? Experts say that the present market conditions of Bitcoin should not deter investors from investing in it. Instead, they have to understand the reasons behind its current market movements. Besides the speculations that Bitcoin is being adversely affected by the institutional and national regulations, investors will very soon understand that the prices of digital assets are also somehow correlated to traditional assets. As BTC matures and becomes more widely used, its price becomes increasingly correlated to the price of traditional assets like stocks. This growing correlation triggers price declines in the traditional markets, which also results in greater price declines for Bitcoin. Monitoring the price movements of the crypto market will also enable the investors to assess the broader financial markets with more efficiency. So is there going to be another bear market trend for Bitcoin? The answer to this question is very speculative, and even if this happens, it should not affect your decision to invest in cryptocurrencies. This is why experts have always recommended keeping crypto investments less than 5% in investment portfolios. A bearish market trend will obviously affect the global crypto market adversely, but it is essential that investors keep their financial bases secured before creating a long-term investment strategy. Bitcoin's latest rise in price is nothing new. In fact, even experts know that the prices will dive down at some point in time. The secret is to stay alert and venture accordingly. Now here are 3 things you should do during a crypto bear market. Buy crypto using dollar cost averaging. It's all too easy to be on the wrong side of a crypto trade when markets turn wildly volatile, but that doesn't mean you have to sit there and watch your portfolio plummet by the hour. Investors who have held back a reserve of fiat currency or stablecoins or have expendable capital in their bank accounts will have the ability to buy the dip. This common phrase used throughout the crypto industry refers to the practice of buying up an amount of cryptocurrency whenever there's a significant bearish correction in the market. The idea is, if and when prices return back to their previous highs, the dip buyers will bank a nice profit. While buying the dip can be done in a single trade, the most recommended strategy is to implement something called dollar cost averaging or DCA. This involves breaking up your reserve funds into smaller tranches and making several trades over time. For example, let's say you have $1,000 in reserve funds. A good DCA strategy would be to break up the amount into 5 tranches of $200 or even 10 tranches of $100 and place trades using those smaller amounts. The thought behind this is, it's incredibly difficult to know exactly when an asset has bottomed out, reached the lowest price before reversing. So instead of spending all your money in one go, it usually works out better to buy a small amount and wait to see if the asset falls in price further. If it does, buy a little more and so on. Doing this will typically garner much better results than if you had invested all your capital in a single trade, unless of course you were lucky enough to go all in at the perfect time. Diversify your investment. Just like it's nearly impossible to accurately predict the bottom of a bear market, it's also impossible to know exactly which cryptocurrency will recover the fastest or go on to rally the highest. One way to hedge your bets is to use DCA for a range of different crypto assets. This might involve reducing your trade sizes even smaller, but in doing so, you'll reduce your overall risk. Of course, it's not enough to randomly select crypto assets and invest in them. You'll want to perform rigorous due diligence first on each crypto asset you intend to buy. And finally, don't freak out. Be patient with the market, and in time your patience will reward you with the fruits you definitely deserve. Hope you guys enjoyed this one. Thanks for watching.